Welcome to Value Investing webinar. Value investing is all about finding that bargain, but how to spot the opportunity, how to escape the falling knives, how to find the opportunity which is compelling one and it will translate into something meaningful for you, and how to exercise patience. Today I have with me Atul Kumar from Quantum Mutual Fund. He has all the track record because he has been there since the start of this fund. This fund has been able to build a track record which is available in public, had the patience to stick to his beliefs and conviction, and now this fund, Quantum Long-Term Equity Fund, is now called Quantum Long-Term Equity Value Fund. After SEBI has made it mandatory for fund companies to really classify their funds into a large cap, mid cap, and they have to stick to it. So they have provided for this value fund and they have chosen to get slotted themselves as a value fund. I have a set of questions which I would like to ask a practitioner like you who has been able doing it. How difficult it is to do it in India. It's a growing economy. Everything was available at fantastic valuation, expecting that companies to do even better. And many of those stories have also turned out to be true. It has been a growth market. So how difficult or easy it is to spot the value in a growth market?
Right. So there have been cycles, there have been phases. Markets have been relatively more pricey at some times, and there have been times where the markets are at kind of relatively saner levels. So the current environment, maybe value is little harder to find in that sense. But obviously there are areas or there are pockets for various reasons where they can be relatively less expensive and one can find some value in them. That can arise primarily from let us say a timing arbitrage is one factor. There are investors who are looking at shorter time horizons, for example, and that's much more exacerbated when we have many hedge funds, etc., who look at quarterly returns, monthly returns, and in that kind of a scenario, one gets opportunities in some kind of sectors can become they can be overlooked, and there can be value maybe in some of them.
So what you're saying is that your opportunity comes when other people go crazy. That when they ignore something because they are primarily driven by the short-term expectation which has not materialized. Is that what you're saying?
Yes, so that is one part of it. The other part would have to do with
the hedge funds, and their behavior will be primarily guided by short-term expectation which did not materialize.
Yes, that is one of the ways in which it plays out. The second thing can be a lot of negativity can be there for a particular sector or something. So for example, there can be news, what we had seen somewhere in 2016 after the US elections, for example, IT stocks were being talked about that there will be issues related to Visa and their business models are not right. So there can be also negative news in a sector, and then one can probably do homework and see that if there is some kind of value which is there in these kind of sectors. Thirdly, it also happens a lot to do with on a macro basis with investors' expectations. For example, in the period 2003 to 2007, people expected that India's GDP will grow infinitely at about 8%, 9%. And then once you had the global financial crisis, the expectations came down very, very sharply because there was some period where the growth was negative. Very recently we saw that in the period after 2014 elections that people once again got very gung-ho and the expectations of GDP were about 8%, 9%. That led to many of the investors driving up stocks to very, very high levels, and probably that was not materializing in what was happening onto the earning side. The maybe fourth instance can also happen, at least it used to happen a lot in the past maybe little more difficult is that there are many companies who would be having a lot of subsidiaries, and there will be hidden values in some of those subsidiaries. And when investors are pricing, so they are either ignoring some of those, or they are pricing it at a lower level, and then as time progresses, many of those companies
get unlocked
they can get unlocked. Companies carve them out, or they do an IPO of that. Then investors start to realize those are some of the
instances. Superior value of it.
Correct.
So we have seen this 2003 to 2007 phase, or what we saw till this budget, the market on a steady rise, a steady climb, and market looks expensive. Everybody acknowledges it. What do you do then? You see the market going up, hard to find value, nothing available at a bargain. What do you do?
Correct. Yeah. So those are really some kind of pain points, and given Quantum's a value philosophy and a process-driven approach that we follow, if there is no upside that we see in a particular company, once our sell levels, once our sell levels are breached, then we do not double guess our investing process. We just go ahead and sell them. So in that kind of a scenario, the cash levels in the portfolio build up, and there are no new ideas which are coming, because typically when the markets are more saner, then maybe what you realize gain out of one stock, you can find a new stock. But in these scenarios, when stocks are rising, there is hardly any new stock which is to be found. So there is a cash buildup which is happening.
How long has been such phase where you don't find anything to invest for a long period of time? What has been this longest period?
Yes, so the period from 2000 around 2006 to 2008 was about, let us say, one such period which had been there for past
in
about one and a half years. Also, we had seen this kind of a period.
And last 1.5 years, meaning mid 2016 to end 2017. Or till this budget?
Yes, till this period, let us say, we have seen for the past 1.5 years, our cash had gone up. Similarly, one of the highest cash which we were holding was in period just after the elections results had come. And that happened on May 16th, when the election results were out there, and then the stocks were going crazy based on expectations. That was the time when our cash levels breached about 30% kind of levels, because when we were seeing on one side the markets were rising up, but as I explained, that when we were going and meeting companies to understand that are they seeing any kind of a real increase in demand, are they themselves seeing that, is there any kind of capex which these companies are doing, the answers to most of these questions were no. So we could understand that it was totally driven by euphoria, people expectations that everything is going to turn out well, there is going to be a hell lot of reforms, and India is going to be on maybe a 8-10% kind of a GDP growth, which did not turn out to be the case.
Now let me get on to the nuts and bolts. Of course, you come every morning, get on to work. But how do you go about spotting that company? How do can you explain me the process of finding the opportunity to be added to your portfolio?
Okay. So the approach at Quantum is a bottoms up approach. We do not look at what sectors are going to do well, where there is a lot of growth. That's not how we are starting. The starting point is a bottom up, and we have about 170, 180 kind of companies that all our analysts, portfolio managers put together. We track them.
So that's your investment universe.
Yes, that's the investment universe. We look at stocks which have daily trading volumes of at least $1 million a day. That has been put
in absolute rupee terms, about 6.5-7 crore.
Correct, yeah. So that has been put in place by the founders from their mistakes when they had learned that until unless there is a good liquidity in the stock, you can always get into some kind of traps, because when you buy, you are the one who's driving up the stocks, and once you are selling, then the stocks lose value and you will have to liquidate.
There's no other side.
Correct, yeah. So that's the kind of our universe. So starting with about 170, 180, which each of the analysts, and we are divided kind of sector-wise.
What contributes to this selection of 170, 180?
Correct, yeah. So
is there any quality parameters besides this liquidity parameter?
Correct, yeah. Yeah, so many of the, let us say, the quality parameters, etc., we are looking at that in great detail. So there can be companies.
But what is the starting point of these 170 companies?
Correct.
Must have some history or any driving criteria, any overriding criteria for these 170 companies?
Yes, so those 170. So right now there will be, let us say, about 300, 400 stocks, which could be about $1 million kind of a criteria. When we filter that down, there will be some of them which could be very, very similar kind of businesses and not, for example, let us say within the banks, PSU banks, maybe something which is, there may be about 10, but all of them are doing a very, very similar kind of a business. We also filter out some stocks based on corporate governance criteria, in the sense that they have to be good managements, and if we are not liking the managements, we will not look at them. Then there will be some companies which could also have...
Can you explain this corporate governance bit? Because this is a very loosely defined thing. How do you spot the poor corporate governance?
Correct.
Just tell me an example without naming the company that you like the company, but you didn't like the corporate governance standard for it to be included in your portfolio.
Yes, so maybe going back some time, there would have been a company which would have met some of the other criteria, but what we have seen is that probably it may not have been very fair to the minority investors, in the sense that promoters are doing something, founders are doing something in the sense that merging one company with another company when there cannot be cash which was there in the books being utilized to do some kind of acquisitions, etc. So there are a lot of the cases, and it may vary from on a case-to-case basis how it happens. But we believe that there are a lot of companies...
You try to decode that it has been fair to all set of shareholders and never shortchanging the minority shareholders.
Yes, we are very, very clear about use that as a parameter. We would never buy into any of the stocks where we have some kind of doubt that the management is, or the promoters have not been good to the minority shareholders, or there have been some kind of issues which can impact the smaller kind of shareholders. So that is one this thing. So this is how the filtering is done. So
you come to the office and you have cash lying in your fund, and it is 30% sometimes, and you have to make a call, buy this today. How does that happen? Which one?
Correct. Yeah. So the way we work is we work as a team. There is a team of analysts and portfolio managers. I mean, as we explained, that it's much more a process-driven kind of an approach. We have our meetings once in a week where we discuss whatever of those 170 companies, which some of them which are being presented by the analysts. So, and then when we are doing those companies, we look at them at a quite great detail. So probably, I mean, as a part of our value investing process, we believe that that is also something which has contributed to the success, because when we are looking at the companies, we have at least a 5-year history, at least 5 years numbers going ahead, very, very detailed kind of work on their profit and loss, balance sheet, etc., cash flow projections,
anticipating the drivers of those numbers in future.
Exactly, and because all of us are looking at it for a long period of time, so you understand that how the business has evolved, what could be the risk factors to those particular business models. So there's a lot of detailed work on that. All the people participate in those meetings, and from there, once the idea is kind of approved, then it moves, then it becomes a part of our database as an approved, and then the portfolio managers take a call. Other part
so what triggers a buy?
Yes, so I mean, for all the stocks that we have, all the stocks, they have an pre-approved buy and pre-approved sell limits. So which we do it. So one
that is for the dealing function to effect.
Not just for the dealing function to affect, but for us to take a call. So let us say today we are looking at X stock, for example, and right now its price is, for example, 100. Now, when we do our research based on our normalized numbers and our kind of evaluation, which is some kind of discount to the median, to its history, we have a buy and sell limit. So as compared to 100 rupees current market price, its buy price, for example, could be 80, let us say hypothetically, and sell price of 120, for example. Typically we look at 40% upside to any stock which we are buying. So we will wait till the time that the price hits that 80 rupees. Till that time we will not take any kind of action on that particular stock. Another part which we do as a part of our research process is that there are some macro factors which we look from the same pair of eyes. For example, the GDP growth, which we believe in our assumptions can be in the range of 6.5%. The inflation, which can be 4.5%. 10-year GSEC, a particular number. So for example, auto analyst who's projecting the auto numbers, he's looking at a kind of a multiple to GDP, which is based on that GDP of 6.5%. And similarly, a cement analyst is also looking at same. So at least on the macro factors, we are not looking at things from a different pair of eyes. It's from the same pair of eyes. Obviously, from that, the modeling of each company will differ. There will be unique characteristics. So
when you're saying that, all your selection or all your investments are bottom up, but these macro inputs do guide your choices.
Yes, so there are on these parameters we are looking at it from a similar kind of this thing.
And then from your experience, because now it is 10 years of being a value investor with a publicly visible fund, which has a reasonable performance track record. From your experience, which are the number of metrics which have proved particularly useful to identify, any number which you relatively emphasize more than others? Any quantitative parameter which you think is always very useful?
Correct. So again, we look at a number of parameters when we are looking at
price to book value, or price to enterprise value, value. But any specific number which has come in very handy?
When we are buying stocks, so one could be, depending on sectors. In some sectors, we have found that stocks as a kind of to their replacement value or to cost up a similar kind of a facility, the current price turns out to be looks like much lower than the replacement value, and that happens in some kind of businesses which could be going through some of the turmoil. For example, if you look way back in 2006, 7, 8 kind of period when the crude oil prices were going up, there were a number of refining stocks which were trading at a discount because they had to bear a large part of the subsidies on their own book, and that was leading to losses on that side. So that was one time when many of the refining stocks as compared to their asset value or replacement value appeared to be
so you bought them at that time?
Yes, we will not talk about individual stocks.
No, but yes, correct, exactly. Generally speaking, that would also have been a very difficult time because you bought them and they will be going down in value because government decided for those companies to absorb subsidies or all the subsidies which the government was providing.
Yes, and we also that is very true.
So it would have amounted to taking a bet on the government stand that this can't go on forever.
Correct. That was the basic premise that if these are the companies which are meeting most part of the energy needs and energy needs are going to grow over a period of time, then these companies will have only when they earn some kind of money that they will be able to expand their operations. So the current scenario which was appearing as of that particular time looked to be kind of unsustainable at some point of time.
It could not have continued
Correct,
for long.
Yeah. And then just to add to that, the cycles can change. So you look just 2 years from that in 2009, those same refining stocks were kind of, the prices kind of indicated that there is going to be a zero kind of under recovery or zero kind of subsidy going into the future. So the markets can move from one mood to a completely different kind of a mood.
Radically different. On the flip side, do you have 2-3 checklist, any checklist of red flags?
Correct.
That okay, this looks like value, but it has this, so I will never touch it.
Correct. Yeah. So I mean, obviously there are a number of red flags, and many a times
The fact that it's a value stock will have red flags. So,
exactly.
Yeah.
That's true. And many a times we discuss more time on what those pitfalls can be than on the opportunity that a particular stock could have. For example, I mean, one of the things which we look at is that on a value kind of a style when you are following, are there really any kind of triggers or so kind of value unlocking? Is there anything, the events which will trigger that kind of a value value unlocking. Which can happen? So I mean, a stock can appear as value, and if there is no growth in the earnings, then it will kind of become a value trap per se. So that is one thing.
So avoiding value trap is the key. So you are looking at trigger which will cause that change.
Correct. Yeah. So the catalyst for that particular stock.
It must be a growing company.
Correct. Yeah. Yes. Okay. Otherwise, you will not be able to make any kind of money on that side. The second thing, obviously, what we discussed is the corporate governance framework is very, very important for us. As our founder says that, I mean, when you shake hands, then you should be able to get all 5 fingers back. But there are many companies in India where you shake hands, you get maybe less than 4, less than 5 fingers on that side. So that is one thing. If you ask me, the other part which we have learned over a period of time to avoid is maybe companies with a lot of leverage. Because, I mean, when the things are going good, then I mean, it's all good. But then when suddenly things change, when there is a global kind of a crisis, or there is a seizure of liquidity, as happened maybe few years back, then that is again something which one has to...
But for many businesses, leverage might be just a important thing for them to function. So it has its good parts. So is it that you are averse to a company with a borrowing, or is there a limit to it in moderation, or do you have some kind of framework that leverage beyond this point is avoidable?
Yes, it is largely to do with leverage beyond a particular kind of level.
The scale of leverage.
Yeah, the scale of leverage. How I mean, can the company really sustain if the times are going bad? And that is what maybe many of the cases. I mean, there have been few cases in the past where a company, let us say, where we invested, and that did not turn out to be very well. For example, there was a textile company which we had invested way back in around 2005, 2006. And I mean, at that point of time, India's textile sector was just opening up to the globe, a lot of global opportunities. And I mean, looking at few of the things, looking at it was a relatively inexpensive stock, we got into that. And then what happened is that suddenly that company was into denims. The denim had got into an overcapacity. There was a lot of leverage which was there. The company had been expanding based on debt. And then suddenly there were orders getting cancelled because they were betting a lot on getting orders from US companies or Western kind of retailers, which were not happening. And there was a lot of competition that came from other low-cost countries such as Bangladesh, which was not maybe factored in our models. But when you look at all of that, that put a lot of stress on this thing. So maybe that was a case where we exited that company without realizing the kind of opportunities which we had. So there have been in our case where there have been at least
a lot of theories, a lot of stories not going the way you expected it to be.
Yes, a couple of them for sure. In my this thing, I have seen at least 5-6 names where we had to exit for some reason or the other when we could when I mean it did not realize its potential, and then with time we have got much more careful about that, avoiding those kind of companies.
How much of a missed opportunity you are faced with, the thinking or the feeling of missed opportunity by being a believer of value investing?
Yes, I mean in at least the near term it looks like I mean, because when you are evaluating a stock and I mean, for your valuation purposes, you miss that, and then obviously it can very well go very, very high levels. So, I mean, obviously that those are the cases where there is some kind of, I mean, let us say, kind of pain that you are not able to. But then we also look at, I mean, when we are doing I mean, all the companies that we do, we also look at historically what we projected and what the company delivered. So what we have seen that more companies we have missed because their valuations expanded much higher. So a company which was trading at, let us say, a 10 time became a 20 time, 30 time, 40 time kind of a number, and not necessarily because our own projections were on the wrong side. So when we were modeling the company, probably we were
not the market.
Yeah, correct. Yeah, so it's a kind of a market.
You could not anticipate the market.
Correct. Yeah. So we are extremely cautious that, or we look at it that we do not miss the numbers so much. I mean, obviously, all of us are humans, and there is a limited projection capacity. But as long as you do not miss the numbers by a wide margin, and it's a kind of a it's a just multiple expansion, we are fine with that.
Sure.
Because what happens that, I mean, in many of the growth stocks, once earnings come very, very well, their multiples can expand. But let us say it can always happen that a sector starts to face headwinds or
and it
a very, very hard.
Too.
Yeah, so that can happen. Yeah. So it's
the reverse can happen as well.
Correct,
so
exactly.
Now we have had a very lavish conversation, but for this episode we have got a set of questions, and I would like to quickly answer them briefly. Balaji has this question that is it better to hold many value stocks with low concentration and or a few of them with large exposure? He is basically asking that should he have few stocks
Correct.
or a good number?
Correct.
How concentrated one should be?
So probably I could follow a similar kind of at least 20-25 kind of stocks, because there has to be a
diversification.
Correct. Yeah, there has to be a diversification because you can always go wrong. I mean, something what you believed a sector can do, that may not happen. Business cycles can change very, very fast. So to protect to a certain extent, at least a 20-25 stocks could be a number one.
Another question which comes as a very straightforward question, that can we distinguish between undervalued and overvalued stocks only on the basis of PE ratio?
PE is an criteria, but one can look at also other parameters such as, because let us say if a company has a lot of debt, then one can look at even EV to their EBITDA kind of numbers. So all of those things can also be looked at.
Just looking at PE ratio could be misleading sometimes.
Yes, sometimes it could be misleading. I mean, it can very well happen that a company in near term is not making profit, but something could give it a lot of profit, let us say, in the future.
A company turning around where it might look very expensive, but it may not be actually so.
Yeah.
Or an extraordinary income can actually boost the earnings.
Correct.
Make
only
it look,
in the near term.
Only in the near term. Vaibhav Singh has this question, that what factors indicate that a company is at its inflection point and turning from loss making to a profit making company? How do you spot a turnaround?
So it could vary from company to company. It could be a very, very specific thing for each of the companies. I mean, the economic scenario could be turning out better for the company. They could be winning new orders, etc. So there is not a particular kind of a formulaic kind of a this thing, but yes, I mean, change in the external environment, change in demand, company itself taking some of measures. For example, if they have a kind of bloated cost structure, they are trying to address that. If they have a lot of debt, they are somehow issuing equities or some other ways in which they are taking away the debt, so that could lead to turnaround.
Okay, now a question which you will be facing a lot in your neighborhood with your friends. Ronak Sheshrao has asked that how can I differentiate between a value-oriented mutual fund and a growth-oriented mutual fund?
Correct, yeah.
Of course, now you don't have to differentiate because now SEBI has classified these. The value-oriented, at least, even if they may be pretending to be one, but now they have to state that they are pretending. So everybody has to state that they are a value fund or a growth fund. Now you can clarify that. How do I spot one?
Correct, yeah.
How do I differentiate them?
Yeah. So one of the ways to look at is the portfolio characteristics itself. In terms of dividend yield, value portfolio will have a higher dividend yield
or
as
price
compared
to book value.
Yes, similarly price to book value, similarly in terms of P ratios, and in terms of growth numbers, the value stocks growth will be, the growth of their portfolio earnings will be on a lower basis.
Relatively
so depending on a PEG kind of a number, the P will be low, the growth will also be relatively low for a value fund, whereas for a growth it will be on the higher side.
So thank you very much, Atul, for sharing all your insights on this area and answering our visitors' questions for them.
Yeah.
Thank you very much for your time.
Yeah, thank you for inviting me and having me here, Dhirendra. It was a
You're
pleasure
welcome.
talking to
Thank
you.
you.
Thanks.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.